So you open your mailbox, and there it is, that letter from the IRS. Your heart just sinks, right? It looks super official, it's filled with scary-sounding numbers, and it basically says you owe a whole lot more money than you ever thought possible. Okay, before you start to panic, take a deep breath. Let's talk about what's really going on here. I want you to look at this number, $85,000. This is the exact amount the IRS demanded from one investor. And this wasn't some shady character trying to hide their gains. No, this was someone who filed on time, hired a CPA, literally tried to do everything by the book. 85 grand. That's a life-changing amount of money. But, and this is where the story just gets completely absurd, that huge $85,000 bill wasn't for some massive secret windfall. The IRS was demanding all that money for a gain that was actually just $13,000. Now, how in the world does a $13,000 gain turn into an $85,000 tax bill? Well, it didn't happen because of fraud, and it wasn't the investor's fault. It happened because of a huge fundamental crack in the entire system. So if a letter just like that one is sitting on your desk right now, listen to me. You are not alone. This is happening to people all over the country who tried to do the right thing. The problem isn't something you did wrong. It's a documentation glitch so widespread that it actually has a name. They call it basis evaporation. Sounds kind of weird, right? But this is the secret villain behind these inflated tax bills. It's the reason the IRS thinks you're a millionaire when you're not. And once you understand how it works, you can actually fight back. Okay, so the main trigger here is a new form called the 1099-DA. Now, exchanges have to start officially sending these in 2025, but they're already reporting this kind of data. And here's the problem. The form tells the IRS how much you sold your crypto for, but it often shows a big fat zero for what you originally paid for it. That's your cost basis. So when the IRS looks at it, they see all this income and assume you got it all for free. You know, to really get how broken this is, just think about the stock market. If you move your stocks from, say, Fidelity over to Schwab, all your records, what you paid for everything, it all travels with the stock automatically. It just works. But in crypto, when you move your assets from one place to another, your cost basis, it just gets left behind. The paper trail is broken, and suddenly it's on you to piece the whole story back together. Let me walk you through a super common scenario. Let's say you buy some Ether on Coinbase. Okay, great. Your cost basis is recorded right there. But then you move it to your own MetaMask wallet. Well, guess what? The cost basis record just stayed behind at Coinbase. Then you bridge that ETH over to the Base network. Poof, the chain is broken again. And finally, you sell it on Kraken. Kraken knows you sold it, and they report that sale to the IRS, but they have no idea what you originally paid for it. That information was left behind 3 steps ago. So your first instinct is probably, okay, I'll just fix this myself. You'll fire up a spreadsheet or call your CPA or maybe use TurboTax. Makes sense, right? But here's the thing. None of those tools were built to handle this very specific, very weird crypto problem. I mean, think about it. Your spreadsheet can't track transactions it doesn't even know exist. Software like TurboTax, it just sees missing data and assumes the worst-case scenario, a zero cost basis. Your family CPA probably isn't a crypto expert, and the ones who are, they can charge up to $400 an hour to manually rebuild this stuff. Even a lot of other crypto tax tools get it wrong. They can't tell the difference between you selling something and just moving it between your own wallets. And just when you thought it couldn't get any more complicated, yep, it does. The stakes just got way higher. The IRS isn't just getting data from exchanges anymore. They're getting a lot smarter about how they check your work. Check this out. On a new audit form, the IRS literally asks you to list every single exchange and every single wallet you've ever used. Then you have to sign, under penalty of perjury, that your list is true, correct, and complete. The key word there is complete. It's not to the best of your knowledge. Forgetting about that one dusty old wallet you used back in 2018 isn't just a simple mistake anymore. It's now a signed legal discrepancy in an audit file. No pressure. Okay, that was a lot of bad news, I know. But here's the good news. This is a solvable problem. You absolutely can fix this broken chain of records and fight back against that crazy tax bill. It's all about rebuilding your history. So the big question is, how do you do that? How do you possibly rebuild a history that's scattered across like a dozen different platforms, some of which might not even be around anymore? You need a tool that can see the whole picture at once. And the solution is this amazing technology called Smart Transfer Matching. It's the engine that powers a tool like Coinly. Instead of seeing all your wallets as separate little islands, it sees them as one interconnected system. It automatically understands when you move coins from one of your wallets to another, that it's just a transfer, not a taxable sale. And the most important part, it keeps your original cost basis attached to your crypto no matter where it goes. Now, for a system like this to actually work, it has to be incredibly comprehensive. We're talking connecting to over 1,000 exchanges, recognizing more than 7,000 DeFi protocols. It has to map out your entire crypto history. And the fact that a tool like Coinly is already trusted by over 2 million investors, that tells you just how common this problem is, and that people are finding a way to fix it. And, this quote from a user really nails it. The best part is seeing the complete correct picture before you ever have to pay for anything. You get to see the final right answer first. And that brings us to the most important point of all. You can actually figure out your real tax number and confirm this all works without spending a single penny. You can totally de-risk this whole process. I mean, just look at this comparison. Most other crypto tax tools, their free plans max out at maybe 250 transactions. Coinly's free plan, it covers up to 10,000 transactions. For almost everyone, that's your entire crypto history, completely sorted out for free. It's really simple. You connect all your accounts, the software puts all the puzzle pieces together, and then it shows you a preview of your correct capital gains number. You only pay if and when you're totally confident in the result and you're ready to download the official IRS forms. So if you're looking at that scary IRS letter right now, or you're just worried one might be coming your way, here is the clear step-by-step path to taking back control. Here's your action plan. It's super straightforward. Step 1, create a free Coinly account. Step 2, connect all your wallets and exchanges. It's totally secure, using read-only access. Step 3, sit back and review the complete capital gains preview that the free plan gives you. And then, only when you're 100% happy with the number, you can choose to upgrade to download the official tax forms to send to the IRS. Look, the bottom line is this. If you've ever used more than one crypto platform, this basis evaporation problem is a real risk. The IRS has the data now, and they're starting to connect the dots. The cost of fixing an $85,000 mistake is way, way higher than the cost of checking your numbers and preventing it in the first place. So the real question you have to ask yourself is, are you absolutely sure the number you reported is the whole story?